what's up guys, John here. One of America's most successful real estate developers is losing his entire $2 billion real estate portfolio. But he's not the only one. In fact, many billionaires, many very wealthy people, institutions, hedge funds, and syndicators are on the verge of losing it all. And we're going to start to see that unravel every single month going forward. It's going to be unbelievable. I'm going to show you what's going on behind the scenes because I think that what we're walking into probably 4 to 5 times worse than what we saw in 2008. That people are going to wish for when we look back on it in 12 months, 18 months, that we just had a 2008 type of situation. This is going to get crazy. But during the crazy times is when real money is made. So I'm not saying this to scare anyone or get anyone concerned, but the more information you have, the more facts that you can look at, the more informed you can be, the smarter decision you can make, the more money you can make, and the better off you are. So that's what I'm going to do for you. I'm going to show you what's really going on. Please hit the like button. YouTube's going to share this content, educate more people about what's really going on. And if you'd like to fix your credit, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any problems on your credit report, do not let it sit there. Chapter 7 bankruptcy will sit in your credit report for 10 years. One late payment will sit in your report for 7 years. Charge-off, 7 years. Don't let that sit on your report and prevent you from getting really in a great situation during this massive wealth transfer, getting funding, getting financing. So go to GreatCreditFast.com. We'd love to give you a free strategy session. Take a look at this. So developer puts up for sale a real estate project around the United States, $2 billion in total build out, right? And the reason that they're putting this property up for sale is part of the receiver sale. And so the reason that they're doing it is because they cannot raise the money to keep it operational. And these are the deals. So you have Austin, right? One of the hottest real estate markets. Well, it was with 80 townhomes, 36 single family homes. It's 40% complete. You have a development site approved for 380 apartments, another development site approved 55 townhomes, another development site, 800 residential units. This is condos, townhouses, apartments, plus retail. So they were founded in 2009, and they were very strategic in their approach throughout that period, that 14-year window. But now, they're trying to get rid of these other deals too. Now they're just trying to get out. They're trying to escape, but they're not going to escape. And now, as this begins to kind of become more mainstream, people are really starting to pay attention. Like, hey, what's really going on in the real estate market? Well, first, rents are getting absolutely crushed right now, especially in the Sun Belt. Rental prices plunge in the Bay Area and the Sun Belt. So one-bedroom apartments in California experienced a substantial 7.2% drop. 7.2% drop. When people are investing in multifamily in San Francisco and California, a lot of these coastal communities, they're buying these deals based on a 5% return or a 4% return. This is what they're doing. When you see a 7% drop in rents and insurance and taxes are continuing to climb and borrowing costs are continuing to climb, it highlights just how bad many real estate developers are right now. They're in a really bad situation. And many people forget what happened last time, 2008. In 2008, did rents go up or did they go down? They went down. Many people think they went up because people couldn't afford to buy a home and they lost their home, so they had to go rent. No, many people got desperate. They lost their jobs. They listed their homes for rent. This is going to happen again. In 2008, rents up 0.3%. and 4.1% in 2009. Well, apartment construction right now is at a 50-year high. 50-year high. So you have all this new inventory hitting the market. You have 40% of all mortgages. 40% of all mortgages are taken out between 2020 and 2021. So you have all these people that have these record low mortgage rates with very little equity in their homes. And what are they going to do? They're going to rent out their homes when the job market changes, the economy changes. So you have all of this inventory coming from the residential market, a lot of these accidental landlords. You have all of this inventory being pushed on the market from these real estate developers, and you're seeing sky high defaults happening right now. This is just the past month. So in the past month, you are seeing this default here in San Francisco office building. More SF office buildings are defaulting on mortgages. Dallas office tower says that they're in loan default. San Francisco sees surge in office defaults. Bad loan in financial district. Right? You start to see all these different situations. Portland, lender foreclosed in Montgomery, Portland's 3rd largest office building. Dallas, right? So you're seeing all these situations, page after page after page. You just have to ask yourself this big question. If this is just a small $2 billion problem, and 1.5 trillion of these situations have to go back to the bank and get refinanced, how many of these people are actually going to be able to get loans? Not many. A really good example of that is David Sachs. David Sachs, he's one of the hosts of All In Podcast, the multi-billionaire. He owns a $15 million property in San Francisco. He owed $9 million on this property. And the lender said, look, we'll give you $2.4 million if you collateralize it, and you put something supporting that $2.4 million besides the asset, besides the building. He just decided to pay it off. They were going to give him $2.4 million on a $15 million asset. That was the value that it was appraised at, $15 million. So when you look at these figures, you look at what's really going on here, you see very, very clearly that problems are coming. I mean, look at the IMF blog, right? What they said, and this came out today, higher for longer interest rate environment is squeezing more borrowers. Elevated inflation means central banks may have to keep policy rates higher in a way that stretches the capacity of borrowers to repay debt. The world's central banks have unleashed the steepest series of interest rate pay in decades during their 2-year drive to tame inflation. And they may not be done yet. Policymakers have raised rates about 400 basis points on average in advanced economies since late 2021, around 650 basis points around the emerging market economies. Most economies are absorbing this aggressive policy tightening, showing resilience over the past year, but core inflation remains elevated in several of them, especially the United States, parts of Europe. Many central banks, therefore, may need to keep interest rates higher for longer. So, when they start to do this situation, they keep these interest rates higher for longer at a period when $1.5 trillion in commercial loans has to get refinanced next year and $2.7 trillion has to get refinanced from now until 2027, it's obvious. It's going to be a bloodbath in commercial real estate and residential real estate. Many people think, these residential, homes are going to be really, really resilient because these record low mortgage rates. But what many people do not realize is that America, we are heavily addicted to debt, whether it be in the job market, whether it be, personal spending. Without that access to liquidity, things change. And as interest rates rise and defaults begin to pick up across credit cards and auto loans and commercial real estate, and the $2 trillion in corporate debt that has to get refinanced next year, what's ultimately going to happen? Banks are going to continue tightening up, and people aren't going to have access to money. Whether that interest rate's 1% or 10%, at the end of the day, it comes down to affordability. What can Americans afford? They're not going to be able to afford insurance continuing to rise, taxes rising, everything getting more expensive with less liquidity. That's for sure. So more inventory is going to hit this rental market, and we're going to start seeing opportunity to invest in real estate to likes which we've never seen before. In this environment, risk to the world economy remains skewed to the downside as the detailed Global Financial Stability Report, though the latest assessment of vulnerabilities is similar to what we've noted in April. The acute stress we saw in some of the banking systems have since subsided. However, we now see indications of trouble elsewhere. One such warning is the diminished ability of individual and business borrowers to service debt, also known as credit risk, making debt more expensive, and is attended as a consequence of tightening monetary policy to contain inflation. The risk, however, is that borrowers might already be in a precarious position financially, and the higher interest rates could amplify these fragilities, leading to a surge in defaults, just like I said. So when you start to look at this situation, it is quite clear that if you are an entrepreneur, you are a business owner, the writing's on the wall. If you're looking to invest in distressed real estate, the easiest option, the most tangible option for new investors is going to be 2 to 4 unit properties. They're still considered residential. You can buy one of these deals. You can live in one of the units. You can rent out the adjacent units. You can do so if you're smart, you're strategic, you have good credit, you have some cash in the bank, you have strong income. Right now is a great time to look at, maybe you have an online business. Maybe you don't. Maybe you're thinking of it, right? Now's a great time to position yourself, because a lot of people are going to get hurt financially in what's going to come in the next 12 to 24 months. A lot of big deals are going to go back to the banks. A lot of small mom and pop investors, a lot of small business owners that own a lot of these small properties, they're going to start giving them back to the bank. They're going to start listing them for sale. They're going to start doing desperate things. Desperate times call for desperate measures. That's what's ultimately going to happen. I would not be surprised to see interest rates hit 9.5%, 10%. I really would not be surprised to see that. And at the end of the day, it doesn't really matter what the interest rates are. It really matters what price you are buying in at. The money's made on the buy. So if you can buy a great deal, and you can do so, and the numbers all pencil, everything really, really makes sense, buy it, and then down the road, if you have the opportunity, you can possibly refinance it. If you don't have that opportunity, you still got it at a great price point. So just make sure you're positioning yourself for what I think is going to be an unbelievable opportunity in the real estate market. When you see these situations, just remember, this is only $2 billion of the problem. 1.5 trillion, that's 750 times this situation is just coming next year. That's if rents do not drop, if mortgage rates do not continue to run parabolic, because this is only going to add gas to the fire. What do you think of this situation? Drop below. Add me on IG. If you want to fix your credit, you want to position yourself for the greatest real estate wealth transfer of all time, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. Book a free strategy session. Get some answers. Maybe you are, you're just unsure of what to do. Maybe you have a problem on your credit report. You're just ignoring it. Ask us some questions. Get some answers. See if something we can do to help you. See if it makes sense for you to move forward to fix your credit. Maybe it does, maybe it doesn't. But get answers to make smart, forward-thinking decisions so that you can invest in what I think is going to be an incredible opportunity. I'll catch you guys in the next video.